Hello and welcome to the BIS Media Briefing on the Annual Economic Report. This briefing focuses on Chapter 3, a blueprint for the financial system, improving the old, enabling the new. Here present to take your questions is Hyun Song Shin, Economic Advisor and Head of Research at the BIS. This chapter is pre-released and will be published at 1300 CEST on the 20th of June 2023. I hand over now to Hyun to make some opening remarks. Hyun.
Thank you, Jill. Welcome everyone to the briefing for Chapter 3 of the BIS Annual Economic Report, where we lay out a blueprint for the future monetary and financial system that could usher in quite profound changes to what is feasible in many walks of economic life. Let me explain what we have in mind by putting things into a broader context. Now, throughout history, innovations and monetary arrangements have coincided with new types of economic activity that have led to dramatic spurts of growth and development. An important innovation was the advent of money in the form of ledger entries overseen by trusted intermediaries, which allowed new financial instruments that bridged both geographical distance and the timing gap between incurring costs and receiving payment. These were paper ledgers for hundreds of years, but when paper ledgers gave way to electronic record keeping, the gains were more dramatic still. We're arguing that we're on the cusp of a comparable leap in the development of the monetary and financial system as these earlier fundamental advances. As you'll see in the chapter, the next big thing is tokenization, which refers to the digital representation of money and assets on a programmable platform. Now, to explain why this is a big deal, it's worth thinking about how our current system works. Our current system essentially runs as a collection of separate databases maintained by banks and other intermediaries on who owns what and who transfers which asset to whom. Now, these databases are digital, but they need to be connected through third-party messaging systems and are maintained by these intermediaries as account managers who are entrusted with keeping an accurate record of ownership and transfers. The major leap introduced by tokenization is that tokens are not just a digital representation of claims, but they also incorporate the rules and logic governing transfers. And this feature opens the door to entirely new types of economic arrangements that are currently not feasible due to incentive and information frictions, even though they make perfect sense from an economic point of view. A very simple example is where a buyer will happily pay in return for delivery of an asset, and the seller will happily deliver the asset in return for payment. Now, currently, these types of reciprocal transactions need collateral, or they resort to bringing in third parties, such as an escrow agent. But often, the transactions don't get made, or they are subject to settlement risk. The case of foreign exchange settlement risk is well known, and we have written about this in several recent BIS publications. Now, there are many important examples of this kind which involve even greater complexity, which we discussed in the chapter. Supply chain financing that involves many small companies spread across different continents is a notoriously difficult problem, which have defied easy solutions. In general, economic contracting opportunities involving many interested parties with divergent interests and with different information typically go untapped. And here, tokenization could cut through the impediments and open the door to more productive use of resources and better risk sharing. So what do we propose? We propose a new type of financial market infrastructure, a so-called unified ledger, which would combine tokenized forms of central bank digital currency, or CBDC, with tokenized bank deposits, and various forms of tokenized assets, which could be securities, or even real assets, such as real estate or commodities. Now, the key is to have central bank money residing in the same venue as the other tokenized claims. Central bank money is the trusted settlement medium that can knit together all elements of the monetary and financial system. Now, it's worth emphasizing that the potential for such a system is not limited to incremental gains in speed and efficiency on what we do currently, but instead to open up a whole new set of economic arrangements that are currently not taking place, or taking place at great cost through added layers of bespoke intermediaries. Now, to a large extent, the full potential will only be clear with time, just as the smartphone apps that have made inroads into people's daily lives have defied the expectations of the early platform developers. So let me stop here, and I'll be happy to take your questions. Over to Jill.
Thank you very much, Hyun. So we now open up to questions, and you can either pose your question in the chat or raise your hand to pose a question. So we'll just pause while we wait to see. So I see two raised hands. The first question from Isabella Kaminska of Politico. Isabella, if you want to unmute yourself.
Can you hear me?
Yes, we can. Yeah, go ahead.
Perfect. I was just trying to understand with respect to the tokenization developments, to what degree does this also include the tokenization of deposits and this idea of eventually banks, being able to differentiate their originated currency from other banks? Because certainly the Bank of England's John Cunliffe has sort of implied that might be one future path, and how likely is that in your worldview?
Well, thank you, Isabella. That's a really a core part of the chapter. As I just explained in the introductory remarks, what we are thinking of in the unified ledger is, first of all, have a wholesale version of CBDCs there to serve as a settlement asset. But the primary means of payment will be tokenized deposits. So these are liabilities of commercial banks and other intermediaries who may be able to issue deposits in tokenized form. The issue is that we would like the system to preserve the singleness of money, which is to say that all the payments, whether it's made using public money or private versions of money, should go through at par. And settlement using central bank money is really the key to that. And this is why we think that tokenized deposits really is much superior to asset-backed stablecoins. And so I think this is where we are drawing on the best features of the current system, I would say, and at the same time bringing in the functionalities that tokenization can also give.
Thank you very much, Hyun. And I see another hand raised from Daniel Hinge from Central Banking. Daniel, if you want to go ahead and ask your question.
Hi there. Thanks very much. So, assuming central banks and private sector and so on decide to go ahead with this, how far away would you say we are from kind of making it a reality? And can you talk through some of the steps that would need to happen between kind of here and there?
Yeah, thanks, Daniel, for that. I would say that many components that we discuss in the chapter are already in place. This is not science fiction. There are already several versions of CBDC experiments that have taken place, not least in our BIS Innovation Hub. But also within the private sector, there have been well-known initiatives conducted by commercial banks and other private sector consortia that have looked at tokenized deposits. Now, what's been missing so far is to bring those tokenized deposits together with the settlement medium provided by the wholesale CBDCs. And we think that's going to be a game changer, because what that will do is, given the ability of central bank money to knit together the different elements of the monetary and financial system, that could really open up the possibilities to much more useful applications of tokenization. We know from the technology that's already been trialed by these various these private sector initiatives. That the technology, I think, is well known. In fact, there is quite a few elements that come from our innovation hub experiments that would also, be able to inform this. And don't forget that there's among the central banks, there is an initiative going on at the moment at the New York Innovation Center. That's at the New York Fed, the Federal Reserve Bank of New York. They're actually looking at tokenized deposits, and they're trialing how tokenized deposits would work in combination with tokenized central bank money. And let me also mention the Digital Real project that's going on at the moment in Brazil. They've already, and this is all on the website at the Central Bank of Brazil. Take a look at that. It'll give you a sense of what's going on. Now, clearly, what we haven't done yet is to take tokenization beyond public and private money and bring in, for example, tokenized versions of securities or even other real assets. There is, I think, a gradation of how difficult or how challenging those would be. I think for securities, it's going to be, on the scale of things, relatively easier because we do already have securities registered in centralized securities depositories where you can actually record the change in ownership through book entry changes. So that's fairly close to something which is tokenized, I would say, and that's probably the lowest hanging fruit. But in principle, we can think about other types of assets. But then, that's going to be a slightly longer term project, I would say, because, there has to be a legal framework that has to follow as well.
Thanks very much, Jon. And there are two questions in the chat that are probably related to this, so we might take those. One is from Ian Hall from Global Government FinTech, and he's asking what happens next after this. With public and private sector working together, who does the BIS think will or could drive this?
Well, I think this is absolutely the central question, Ian. And as I mentioned, there are already several projects that the Innovation Hub is conducting. Our multi-CBDC projects in the Innovation Hub, they have involved the tokenized forms of central bank money only. We haven't incorporated tokenized deposits onto that kind of platform. On the one hand, on the other hand, we've had commercial banks and private sector consortia that have experimented with tokenized deposits, but in a more of a siloed setting because that's very much within the confines of that commercial bank. I think the next important step would be to bring the two parts together, and it would be a very natural step. For example, in this kind of collaboration where a central bank or a group of central banks could come together. They have a public policy mandate rather than commercial interests, and so would be very well placed to play the role of an honest broker, as it were. And I think there would be a great deal of alignment, both in terms of the interests and actually the vision of how these things might go. So I think we will need to start that discussion. But I think there are several principles that are reasonably clear. I mean, we need to have a coming together of the interested parties. I think central banks need to have a role here because they provide central bank money, after all, which is the settlement medium. But most of the customer-facing activities are going to be done by the private sector. So we need the private sector there as well. And I think it's going to be a very important coming together of both the official sector, as well as the private sector. And rest assured, this is going to be something that we will be discussing, going forward.
Thank you very much, Jon. And I think that probably addresses the questions from Terry Erikstad of the Norwegian Business Daily. But Terry, if there's anything else you want to add, let me know. He had the same question about who would start the new FMI. So I also see there's some hands raised. So I'd suggest we go to Liwei Wang from Caixin. Liwei? Liwei is still waiting. Hopefully you can get through on the audio. If not, we'll come back to you.
Can you hear me now?
Yes, perfect. Go ahead.
Yeah, thanks. So, say for retail users, what kind of difference will this vision or say this system have compared to the current payment system, say WeChat and Alipay, or say the current CBDC system like piloted in China and some other countries? Right now, will this replace the need to do retail CBDC? And as you mentioned, this M-Bridge project, the current situation perhaps is domestic retail CBDC, like in China, also in Hong Kong, is not particularly useful for retail users, given already prevailing payment methods. But this cross-border use of CBDC might be very useful. How will the system you envisioned kind of feature in this landscape? Thanks.
Yeah, thank you, Li Wei. On your first question on what retail users could do beyond the current system, well, the whole point of having tokenization and having the unified ledger is precisely to bring different elements together and have all the operations executed as one, seamless operation. So, for example, in the supply chain example that I just alluded to, and which we also discuss at some length in the chapter, the idea is that you can harness the programmability capabilities to formalize, if you like, the contingent performance of actions. So, rather than simply, sending money and then hoping for the best, you can program in, release of funds dependent on, where the shipment is relative to, where you, contracted before. We can do this on the basis of even real-world data, like the GPS location, of the cargo. That's more for small and medium-sized enterprises. But for a purely retail setting, let's say that you're a household investor and you would like to enter the government bond market. So this is not currently happening. We would need to bring in securities onto this kind of platform. But once that's done, what you can imagine is that when you just open your app, you can have it. You can have the trading, the reconciliation, and the settlement all done instantaneously, rather than having to wait 2 days, rather than having to have also the operational risks and FX settlement risk and other risks being intervening. But I think there's a general point here, which is, those are examples that we can envisage right now. But to a large extent, this may be just the tip of the iceberg, because just like the iPhone example that I mentioned, the potential for new applications is really only limited by the imagination and ingenuity. Now, on your question about the retail CBDC, now we're not dealing with retail CBDCs, in this chapter, and we can, certainly sort of have another session with you on that. What we do say in the chapter is that retail CBDCs would have value also, because it reinforces this idea of the singleness of money. So, the great achievement of the current monetary system is that whether you pay using cash or whether you pay using the app of Bank A or the app of Bank B, it's all the same money. It's singleness. It's the singleness of money. It's not as if, if you use the app of Bank A, that's, if you like, Bank A money, and if you use the app of Bank B, that's Bank B money. That doesn't happen currently because everything is settled using central bank money. So when we go across the banks, we actually settle using central bank money. So this is the beauty of the singleness concept, and this is why, this is a feature that we should try and preserve if at all possible. So in that respect, we think retail CBDCs also have value because it reinforces that singleness, because it gives you a kind of additional line directly to the issuer, which is the central bank. And after all, money is a central bank liability.
Thank you very much, Hyun. So there's another question from Chamomile Chumba of CoinDesk asking about what would actually make it. So would it use blockchain technology, and how does that unifying everything kind of practically happen?
Yeah, thank you, Chamomile. Certainly we're not thinking of permissionless blockchains because the blueprint that we've just outlined, that has central banks, it has commercial banks, it has regulated institutions that are already currently, part of the current system. Now, the actual consensus mechanism, if you like, the actual mechanism for effecting the transactions, I mean, that could be decentralized. But I think the actual, choice of technology, that will really have to be decided for that particular use case. It could be decentralized, like in a permission blockchain, but it doesn't have to be. It could be a centralized system as well, where there is a rigorous set of controls on data confidentiality, cyber resilience, and so on. And so I think the detailed technology implementation of this kind of infrastructure is probably less important than the architecture. And this chapter is really more about the architecture.
Thanks very much, Hyun. We've another hand raised. It's Nikki Morris, I think, from Ledger Insights. Nikki, would you like to ask your question, please?
More to the technology rather than the architecture. Some central banks have pushed back against wholesale CBDCs, and they prefer a trigger solution, which arguably doesn't give you the full atomic settlement that you referred to. So I'm curious what the BIS's position is on the kind of trigger solution versus wholesale CBDC debate.
Yeah, in fact, this is a very important point, and we have a long discussion actually in the chapter, and we have a whole box, devoted to this particular question. It's certainly true that we can get some of the functionalities of tokenization of these kinds of programmability functions by interlinking the current system, interlinking the different components of the current system through APIs, for example, application programming interfaces. And we could potentially build quite elaborate networks of these. But what we say in the chapter, and I think this is a very important point, we know from the history of computing and in software that if we go for a more incremental solution, that's going to be easier in the short term. There'll be less upfront costs. The governance will be easier. But at some point, you're going to be held back by the need to remain compatible with the legacy systems. And the more layers you put on top, the harder those constraints will bind. And at some point, you're just better off starting with a clean slate. So what we're saying is, when we think about the functionality and what potentially we would like to do, this kind of unified ledger where we have a central bank digital currency in tokenized form right at the center, it can actually bring about many of the functions in a much simpler way. It's a much cleaner way. The challenge, of course, is going to be more that there'll be a bigger upfront cost. There'll be a longer discussion that's needed to get the governance set up in a way that brings everyone along. So there is a trade-off, and certainly there is no one-size-fits-all. And those who argue that a more incremental solution is best. I mean, there is also some point to that as well. So I would not say that that's a wrong argument, but it's a trade-off.
Thanks very much, Hyun. So there's another raised hand from Larry Parks. So Larry, if you'd like to ask your question, please.
In the United States, there's long been recognized the need for a global currency. In fact, Paul Volcker made that point many times. However, in the United States, the government, as opposed to all the other countries, is not sovereign. And it's limited by the limited powers in Article 1, Section 8 of the Constitution, There are three monetary powers here: to borrow money, to tax money, and to coin money. And it also provides in the Constitution, in Article 7th Amendment, that any powers not given to the government are reserved for the state and the people. So my question to you is, are you anticipating that the United States Constitution will be modified to give the government the power to have central bank digital currency? And if not, are you anticipating some workaround? I mean, I don't understand how you're going to get this done.
Well, thanks, Larry, for that question. Shall I take that, Jill?
Yes, please,
Yeah.
yeah.
I mean, so Larry, as you know, there are many, many strands in the debate about CBDCs. There are, questions about wholesale, which is available to financial institutions, or to retail, which is CBDC that's available to general users. There are issues to do with disintermediation of the banks. There are also questions about whether individuals should have access to the central bank balance sheet and so on. And I think what you're saying, I mean, it's a little bit sort of taking us away from the topic of this chapter. But central bank reserves that commercial banks hold, I mean, that is already an electronic version of central bank liabilities, and that's already held by commercial banks. And so, if that's what you're referring to, it's already happened, and it's already being used. What we're saying is we can think about additional functionalities on top. So I think I will just leave it there, Jill.
Thanks very much. And then turning to back to some of the questions we've received on the WebEx chat, a question from Ya Gao of BIS Media Group, asking what are the possible risks of doing so setting up the unified ledger, and how can these risks be minimized?
When we set, whenever we set up a new financial market infrastructure, we have to be doing it, in a very methodical way, making sure that all the steps are, done with a great deal of thought. Clearly, what we need to do is make sure that we build on the strengths of the current system. So, in terms of privacy of individual consumers, individual users, it would be very much similar to our current system, because the commercial banks, they are the custodians of personal data, and there are very stringent rules on how that personal data can be used. That would still be exactly the same in this system. If you have a tokenized deposit, the banks would still be subject to the same kind of rigorous rules on personal data and how it could be used. The central bank is going to be dealing with wholesale CBDCs. It's exactly what they do today when they transfer digital reserve holdings across banks. Now, where there is a new element, of course, is that when we bring all the different elements together on a unified ledger, we have to make sure that the same kinds of data confidentiality that exists today are also preserved in the new system. And so what we say is there has to be very important data partitions that are built in, so that that confidentiality across the different parts of the ledger are maintained. At the same time, we need the cryptographic techniques that will actually allow us to combine the data in a secure way across the different elements, of the ledger. So those are things that are going to use current technology. I mean, there is still there is a great deal of work that's already being done on cryptographic techniques, on these kind of partitioning already. But clearly, we need to have the highest standards to make sure that we don't introduce any weaknesses. And of course, we shouldn't underestimate the challenges from cyber resilience as well. So we have to have the highest standards on cyber resilience.
Thanks very much, Hyun. So we have another question from Akio Fuji of Nikkei, asking how much support does this proposal have from BIS members, and is it feasible in the current fragmented world?
Well, Akio, if you look at the list of projects that are currently being undertaken in the BIS Innovation Hub, we have a very, very active set of projects. Even in the CBDC arena, we have the multi-CBDC projects, the Enbridge project that is run out of Hong Kong, the Dunbar project from Singapore, and also Project Jura that's run out of the Innovation Hub Center here in Switzerland. So there's already a great deal of discussion and collaboration across central banks. The BIS, as you know, is also home to the standard setters in payments. The BIS Committee on Payments and Market Infrastructures, the CPMI, it brings together all the major central banks to have very in-depth discussions and also set standards on this. I would say that there is a great deal of very meaningful discussion and collaboration, and so I don't think it's something that we should be too pessimistic about.
Thanks very much, Hyun. So I'm conscious I can see 2 more questions, kind of second round questions. Is there anybody that hasn't asked a question that would like to either raise their hand or put a question in the chat? Just pause for a minute just to see if there's any other raised hands from people that haven't had a chance yet. So I don't see that. Okay, so I see Nikki Morris from Ledger Insights has a hand raised again. So Nikki, do you want to go ahead with your question?
Hi, I've actually got a page of questions reading out. So one of them is around the earlier person's questions around timing, and it's a 2-part question. So the one is following up on my previous question, these intermediate solutions. Some of the feedback we've had from people who are already running projects is that the intermediate solutions can actually effectively make them less economically attractive. In other words, if it's trigger payment solutions versus a wholesale CBDC, it's not the same, doesn't get rid of the reconciliations, and therefore the full benefits can't be felt. So that was the one part of it. And the other part, also related to timing, is the regulated sector, or the highly regulated sector, is not working in isolation. There is competition from stablecoins, and stablecoins are very much eyeing commercial payments. And if you're looking at 4 years out before there's a wholesale CBDC, that's 4 years. Stablecoins in 4 years' time could be, massive in comparison to what they are now. I know that you'll say that they're, less secure and they're fragile, et cetera, but they don't look as bad as they did a year or 2 ago, and you have 1 or 2 players who have a lot of institutional relationships. So where do you stand in terms of this speed of rollout issue?
So those are so thanks for those questions, Nikki. Maybe we should have a separate session on your page of questions. On the intermediate solutions, you're absolutely right that a wholesale CBDC in the full tokenized form is just a much more powerful instrument that can open the door to many more things one can do. And this is partly what I mentioned earlier about having to build layers on top of legacy systems. You can just, if you can start with a clean slate, you can get there much quicker. I don't think you have to wait that long because if you look at the New York Innovation Center website, they have a couple of pages actually on their project on tokenized deposits. And if you look at the list there, it has not only the Federal Reserve Bank of New York, but also many of the larger commercial banks that they're partnering with. And I think what that shows you is that the interests are pretty well aligned. It's just a matter of making sure that the technology works in a smooth way, that we haven't overlooked anything. Now, whether stablecoins will steal a march, I think that's really up for debate, I would say, to say the least. Because if you read the chapter, what we say there is stablecoins are different from deposits as we use currently. So even though they are liabilities of the issuer that are redeemable in the sovereign unit of account, they are bearer instruments in the sense that, if I transfer a stable coin to someone in making a payment, basically there is a direct transfer of that liability to that new holder. And the issuer has no say in that. So the issuer has issued these stable coins, it's circulating, it's a circulating asset essentially. And when I make a payment, it just gets transferred as a bearer instrument. It's only when that new person, might want to redeem, that's when the new intermediary, would find out even. So what that brings is the idea of exchange rates between stablecoins. Because, a stablecoin issued by one intermediary might trade at a different price from a stablecoin issued by another intermediary. Now that deviation could be that deviation from par could be very small, but anything that deviates from par doesn't really look like money as such. I mean, those are financial, assets really, and whenever you have these kind of deviations from par, what that does is you're so focused on the value up to the decimal point that you start to begin to wonder about how the value will change. So the reason why it might deviate, I mean, it could be something as simple as, look, I trust the issuer, but I'm not sure that other people trust the issuer, and so when I hand this stable coin to someone, I may not be as assured that this will be taken at par as I would be. And so even that higher order uncertainty means that stable coins would lose, to a large extent, this idea of money being a convention that everyone just uses, without a second thought. A pound is a pound. Whether you use cash or whether you use a bank app or whether you use a fintech app, a pound is a pound. That's not the same with stablecoin. So I think for this reason, we are less keen on stablecoins as a kind of private version of money on a tokenized platform.
Thanks very much, Hyun. So I can see there's one more hand raised. I just want to offer the opportunity to anybody who hasn't had a question so far to either raise hands or raise questions in the chat. I'll just pause for a moment to see if there are any new hands or new questions in the text. Okay, so I see a raised hand from Isabella Kaminska. Isabella, if you want to ask your follow-up questions, please go ahead.
Yeah, so it follows up nicely from what Hyun was saying just now. So I'm trying to understand, like, if I'm writing a story for the public, like, what does it really mean, tokenized deposits? Like, are we talking about de facto unbundling all these sort of liabilities? So when I look on my whatever app I'm using, I can see the origination point of all the different pounds that I have in my wallet. In which case, is it going to be like NatWest coin, HSBC coin? And is that helpful because in the event of a bank run, you will then know which part of your deposits are at risk? But at the same time, if that is the case, and if I've understood that correctly, because I don't see how the regime you're kind of advocating doesn't go down that road where you see these, someone will be able to differentiate all these source points. If it does, how do you then prevent sort of the discounting of various flavors of coins against each other? Because even if you guarantee the singleness of money via the settlement through the CBDC, that doesn't stop other factors coming into play in some way, creating a run because of a perception that one part of the deposit base is more risky or problematic than another.
Yeah, thanks, Izzy. I think this is very much what I I mean, I can just maybe elaborate on a few things that I said in answer to Nikki's earlier question. I mean, the way that we think about this is that we are going to transfer all the key features of the current two-tier system in tokenized form, so that we preserve everything that's working at the moment, and then add the capabilities on top. And so, when we talk about the singleness of money, it's important to note that it refers to the payment, rather than the, if you like, the store of value component. So, and that's a very important distinction. So when I make a payment using a banking app, the bank will debit my account, but then the settlement goes through the central bank balance sheet. So in effect, the payment across the bank, across the two banks, would be made in central bank money. So that, that's why the payment goes through at par. It's not a direct transfer. Now, you're absolutely right that bank liabilities would have different values, and we know that from negotiable CDs, for example. If you have a negotiable CD, or if you have a bank bond, they will have a market price, and that market price depends on the creditworthiness of the bank, and so those will deviate in price, but those are, if you like, the stores of value. They're not about the payment. So when we say preserve the singleness of money, we're referring to the payment. When you make a payment, you can be sure that if the settlement takes place in central bank money, in effect, the payment is using central bank money. There's no direct transfer of a bank's liability from one holder to the next. I mean, this is why stablecoins, open the door to these kind of deviations. With tokenized deposit, there is no such possibility because settlement is using central bank money. And so I would say that in terms of payments, clearly the singleness is assured, and that's no different from our current system. If you're saying, there are additional, set of considerations when it comes to financial stability, well, of course, and that's already, there today. But it's the payment and not the store of value.
Thanks very much, Isabella, and thank you to everybody for your questions. A reminder again to observe the embargo for reporting. This chapter is pre-released and will be published at 1300 CEST tomorrow, the 20th of June 2023. The full AUR will be published this coming Sunday, the 25th of June at 11 a.m. and will also be broadcast live on the BIS website. On behalf of the BIS, thank you very much, everybody, and we look forward to talking to you again soon. Thank you.